A financial ratio analysis is a way of looking at performance metrics for a company, and for example, comparing line items on financial statements to look into different measures of financial strength and operational efficiency. So from a financial strength standpoint, for example, current ratio is a commonly used liquidity ratio, where on the balance sheet you're looking at the current assets, which is all of their assets that are either cash or will become cash in the next 12 months, and then you compare that to their current liabilities, or the debts due over the next 12 months, to create a ratio of how much cash versus outgoing expenses will be required to look at their liquidity. That's the current ratio. Other ratios of operational efficiency or profitability are just looking at the different margins down the P&L. And one way of doing a ratio analysis is comparing those over time to see are we strengthening margins by improving operational efficiency and managing costs in a way that we're building margins over time. So a ratio analysis can give us insights into that. I mentioned current ratio. A very quick read on liquidity. Investors, especially with the volatility that exists in the market nowadays and with economic circumstances, wanting to know the company has adequate cash to meet all their short and mid-term needs. So current ratio is a good one. Equity ratio is one that comes to mind because people are always asking what's an appropriate equity ratio, and like all financial questions, it depends. It always depends. Kind of depends on the industry. It depends on the position of the company in its life cycle, but an equity position is kind of looking at the total asset value of a company and how much of that they hold in equity, stockholder equity, versus how much they have debt leverage against. And there are some rules of thumb of saying, 20% equity ratio is common and considered a decent, depending upon the position they are in their life cycle, a decent equity position where they're holding a certain amount of their assets in equity, but leveraging to help facilitate growth to some degree. But again, it really kind of depends on where they are, because some companies that are farther along in the life cycle might be in the 40 to 50% equity ratio, where they're still using some debt leverage for capital allocation and means of or how to deploy their capital in creating growth, but have deleveraged the balance sheet, so to speak, compared to some companies that are maybe younger or newer in the life cycle that are more aggressive on leveraging and creating growth. So that's an equity position is one that's asked about a lot. Ratio analysis is looking at different line items on the financial statements and comparing those, particularly over time, to see to give insights into different strengths and weaknesses of the company, how it's performing. Are they moving toward their goals of creating greater financial strength, increasing operational efficiency, improving profitability? So ratio analysis can give you the insights into comparing those financial results that show as a company moving towards its goals.